Welcome back to CEO Money. It's Ed Baxter sitting in for Michael Yorba. Typically, we have the private equity spotlight at this particular moment, but today we have a very special thing for those of you who like things that are forward-looking and people who are experts at what they do. Joining us is Mike Markowski, visionary analyst and also one of our contributors here at WFN1. Today, his expertise is the type that we look back and we think at the time at Lehman and other bubbles where we had obviously a credit bubble in, but here's one of the guys that helped predict that. Mike, you out there?
Yeah, Ed, how you doing?
Hey, man, glad to have you back. Glad to see you again. Maybe we can talk about Florida State some other time. But, Mike, I heard you got a bombshell for us. What do you got for us today?
Well, one of my core areas of expertise is in forecasting markets, and especially market crashes, like I did with Lehman and predicting that in September of 2007 in my magazine column. And so anyway, what's happening is that, I'm really glad to be here on the show here with you here, Ed, today. And
thank you for being here.
The stock market, since, for the last couple of years, has been at one of its highest relative valuation points over the last 100 years, like expanded PE multiples, just expanded multiples everywhere, and really at the top end of where markets should be valued. So I've been doing a lot of research on a bubble that I discovered back in 2016. And that bubble, which was the biggest bubble in 15 years that I'd seen back then, it has expanded and it's probably about doubled its size. And that was because of likely would have popped if Hillary Clinton had been elected. But since Donald Trump was elected, everybody was very enthusiastic, and that just basically made the bubble grow even bigger. So now the bubble's just about twice the size of what it was. And so it's really, it could be a disaster waiting to happen, this bubble, and could happen any time this thing could break. We have it, actually, there's a picture of it along with the other 6 or 7 bubbles that have been in the stock market over the last 15 years, so you can see the relative size of it. And there's an article about it on the website. So the picture of the bubble is on the website. There's an article about the bubbles on the website. Just look under visionary research. And
you read my mind. I was about to ask you for the website so we could actually look at the bubble itself. How does it compare to previous bubbles? Obviously, we saw one in 85. We saw others in 2000. Saw one in 87 that was pretty ugly there. Obviously, 2008, 2009, 2007. If you were to compare this bubble to those bubbles, where would you put it?
I would say this is much, much bigger. It's much, much, much deadlier than the other bubbles, and because it's really grown up out of proportion. It's hard to, but you can see it. We clearly have depicted and put the bubble on there, and you can see it. And there's also a video that you can watch at WFN1.com in one of the articles there. In fact, I think the bubble there's an article there about the bubbles. And it includes a video, so you can see the bubble, but it's significant. And when it bursts, this market is going to come off by 50% at least.
Obviously, Mike, that's a pretty hefty call. When you think about a market that actually would have that kind of depletion, what would a savvy investor do to look at potentially hedging themselves against a situation like that?
Well, including there's a 90-10 crash protection strategy that every investor should know about, and it costs hardly anything to deploy it. It explains it. There's a video about it too in the articles that are posted on the site. Now just so you understand, I'm going to be here on the show regularly. I'm also posting videos and my reports on the site. So there's multiple reports and videos now on the site, and so people can really go up and get up to speed on this, and they can sign up to get into the newsletter and then get more information as it comes out. They can get it on a timely basis instead of me coming on the show like once a week or so. If something happens short term, they'll get the information much quicker.
Mike, one of the things that I look at, obviously having spent my entire life in the securities world and looking at, I spoke to one of our other guys a while back about the movement toward a 3% T-bond rate and typically what that looked like. Also, the fact you have a huge expansion in consumer credit. and you have really what amounts to what some people would say is somewhat of an overkill or overblown housing market also. And a lot of that is a function of a significant amount of credit that's been driven by the equivalent of 0% interest rates in this market. Do you see those things playing a role in creating this bubble?
Oh, absolutely. There's no doubt about it. And I think that's where the big risk is in the economy, is that, the Federal Reserve is going to have to. I mean, these tariffs are going to basically cause price increases, because, for the companies they help, there's another 15 companies that, they need that. American companies are going to be hurt by these tariffs too. So they're going to have to jack the prices up. So with prices going up, the Federal Reserve is going to hike interest rates. And when they hike interest rates, that's just one of the catalysts that will pop the bubble.
Well, obviously, you'll have to have some type of situation as far as the Fed is concerned to, I guess, look at a Greenspan style, step up as far as rates is concerned in lieu of some draconian rate change. But the reality is once you change the dynamics of credit in a country, you also change consumption. And that can be something that can be negative for GDP. Do you see, or what do you see a government or Fed or even the Congress doing to try to alleviate that particular type of scenario?
Well, I think that the problem with this situation as compared to any that I've seen in my 40 plus years in the markets is they're starting from a very, very low interest rate to begin with. So typically when you would see credit tightening, they would lower rates, but rates are already low. So the fact is that the rate, so that really they can't do much to lower rates to stimulate the economy. That's a problem.
Maybe it's a little overstimulated right now. I mean, I would argue that the economy's full of a lot of hot air at the moment. And, some people argue one way or the other. And obviously people want the economy to grow. You have a very tight job market. You have an increase in the cost of actually creating things. So obviously if you add, as you mentioned before, tariffs to that, you create a different scenario when it comes to, having demand kind of continue where we want it so we can support it in lieu of having a decrease in demand. All of a sudden you have an economy that starts to erode. And if you throw in the possibility of a significant loss in confidence from a market that potentially could drop 50%, that sounds pretty draconian.
Well, yeah, and the big risk, Ed, is that if the market starts dropping, see, this is the first month. The end of February was the first month where people actually saw their portfolios down for the year at the end of February. And so now people are starting to get cautious. So what happens is the flip side happens. I mean, we had a market last year that was, I think there was only 3 or 4 days the entire year last year where the market went up more than 1%, down more than 1%. Hell, it did that 11 times during February. So when you increase that volatility, people get nervous, and when they get nervous, they pull the trigger and sell. And that's what so that's why this is very dangerous, what's going on in the market, because there was no pulse. Now all of a sudden there was all kinds of volatility.
Historically speaking, I spent as a trader, I spent a lot of time studying Joe Granville, which, a lot of people aren't necessarily familiar with Joe Granville and his on balance volume metric that I use a lot as a trader. The one thing that you see is you are starting to see a significant amount of outflow when it comes to positive acquisition volume is what I would call it as far as the market is concerned. If you continue to have the volatility that you saw in February, would you continue to expect to see people taking quality outflows coming out of the market in certain securities?
Well, yeah. In fact, there's another article that I wrote in February. It's also on the website, I'm pretty sure. And it talks about that there was a record outflow. The biggest outflow in a 4-day period out of the Spider ETF was like $16.7 billion. It shattered all the records for the previous 10 years. That indicates to me smart money's coming out of the market. Okay. And you look at the other times that's been pulled out, it's really just before the markets had serious corrections, and in 2008 and at times like that.
Well, I know for me, being in the private equity world and being an acquirer of companies, the one thing I see more than anything else is there's a tremendous amount of competition to acquire businesses that typically weren't necessarily on the radar of certain types of investment groups out there that carry obviously a lot less volatility on the private side and the public side. We're going to break for just a minute here, and if you'll hang on just a second, we'll come back and we'll talk a little bit more. Is that okay with you?
That's fine, yeah.
Perfect. Again, it's Ed Baxter sitting in for Michael Yorba at CEO Money. We'll be right back with more of Mike Markowski and the big announcement. Welcome back to CEO Money. It's Ed Baxter sitting in for Michael Yorba, who's taking his 73rd vacation. We're right back with Mike Markowski. Mike, one of the things interesting about the markets in general, the markets tend to telegraph more of a look at the future versus what happened yesterday. And I think we kind of see that happen to a certain extent. Now, obviously, with you predicting the issue with Lehman, and I'll, in the interest of full disclosure, I'll tell you too, I actually shorted financials back then because I was still trading actively. And also, I told you the story before of how I shorted Merrill Lynch in the 90s and wrote it down to nothing. So these things aren't necessarily new. They just kind of repeat themselves. When you look at what's happening right now, how much more of a repetitive pattern do you see based on that financial activity then and now?
Well, I think that you're right, and there's an old saying that if you don't look at the mistakes that were made in the past in history, and you don't look at those, you're doomed to repeat them. And the one thing I've known about the markets since for the last 40 years is it's all based on math. So the bubble that I've identified is the relatively the high valuations of stocks versus bonds, the huge gap that's in place. And that's a mathematical correlation. So we're talking not exactly the same things that happened in the year 2008, but it's more similar to what happened in 1929. And I'm doing a lot of work right now in 1929. And the thing that's the shocker that I have that I'm going to come on the show with, probably later this week or next week, is I've discovered that the history books are wrong about the crash of 1929. Okay, the crash everybody says the crash was caused because of greed, excess speculation, all this stuff. That's not what caused the crash. What caused the crash of 1929 was the Smoot-Hawley tariff. Right. Big part of it. No, but let me explain this. This is why this is going to be a great show, and I got to get on for in the future. Is the Smoot-Hawley tariff wasn't passed until June of 1933. 1930. Right. So how the hell? I'm saying to you that tariff caused the market crash. I have the information. I'm putting my whole report together. Well, there were a lot of people who felt like they were kind of forward thinking when it came to it, because you had a lot of discussion in Congress then too at that point about that particular act. And ironically, one of the authors of that particular legislation, it lives here in Texas years later. So we have a pretty good, interesting understanding of the Smoot-Hawley. The one thing I would also mention too is the land crash in Florida. One of the things that from a trader years ago, we would always say that if you can't sell what you can, you sell what. If you can't sell what you want to, you sell what you can. And a big part of the market was the drop in liquidity in South Florida real estate, where a lot of people in New York had a lot of investments, and all of a sudden they couldn't liquidate them. And a big part of the crash in 29 was a function of people looking for liquidity wherever they could get it. Yeah, it was, but it's amazing the stuff that I have, and I'm going to put I'll put an article about that out and put a video about that out, and we'll talk about it on the show. I'm sure you're going to be looking forward to talking about that on one of the upcoming shows. But I just find it fascinating because because the history was written wrong, people don't know how serious these tariffs are. Okay, how bad they are for the world economy and even for the U.S. economy. Well, we can always go back to Adam Smith and the invisible hand, because if you think about it, there's things that we do well in the United States, and there's things we don't do so well. There are things we can do efficiently. There are things we can't do so efficiently. So anytime you're in a position where you create a lack of pure competition, you create a scenario where you have an imbalance of the ability to be efficient in economies. And I think that's really what you're talking about when you talk about putting tariffs on a particular type of product that may actually be manufactured in a much more efficient manner outside the United States versus inside the United States. Yeah, and what it does is it jacks the prices up of everything that has steel as a component. So, when you raise the tariff, but people shipping it in, that means that the U.S. producers can raise their prices by about 20-25%. I mean, that's basically what it is. You've just given a price hike to all the domestic producers of steel. If everybody else is shipping it in, they're going to sell it at a little below or whatever the case is. But the bottom line, they're going to be able to jack their prices up, and that's going to affect everything. I mean, I saw an article about Campbell's Soup saying they're going to have trouble making, soup cans anymore because of the new prices of steel and
Right.
aluminum that are going
Steel
up.
and aluminum coming from Australia. So obviously that could affect them.
Yeah.
Mike, let me cut in there. We have about a minute left or so. Give us a preview on what you'll be doing as a contributor to WFN1 and how we can look forward to the next things you'll bring to us will be revolutionary.
Well, I'm going to be bringing, my focus is on startups that have the potential of multiplying by 100 times in value, high-risk startups. And these things will, Uber and Airbnb, to give you an example, are disruptors. And regardless of what happens to the economy, they're going to do just fine, those kind of things. That's what I'm looking for on the long side. On the short side is really, I'm focused on really macro market stuff and looking at historical patterns and that are going to affect the stock market. And I see them out there, and we're in a period of very, very high risk on the stock market side, and I'm going to be reporting on that, providing research reports and articles and videos on the website, WFN1.com.
Perfect. Mike, got to cut you off there. I want to thank you for choosing WFN1 as a platform to bring that information to, and thank you for helping educate me about the things we see going forward.